All right, welcome back. We're talking about capital allowance, and let us take this illustrative question on capital allowance. A very straightforward one that will introduce you to capital allowance. So, by the time we are done with this question, you will know the basic things to do when you are confronted with a question on capital allowance from the very simple aspect. So, let's go. Mr. Kayode has been in manufacturing business for several years. In the year 2007, he acquired the following assets. This is the first point here. He acquired the following assets. So the fact that he has acquired assets, and of course, we want to believe that if we use this asset to generate revenue, he will be entitled to those assets we claim capital allowance. Are we together? So if this asset will claim capital allowance, what type of capital allowance will the asset claim? They will claim 1, initial allowance. And why will they claim initial allowance? I will explain. They will claim 2, annual allowance. Okay? They will claim 3, investment allowance. Okay? Are we there? These are the 3 basic allowances an asset can claim. Initial, because the asset is put to use for the first time. Initial, because the asset is put to use for the first time. So, therefore, it is not an old asset. Take note. I said that in the lecture notes, that initial allowance is granted on an asset in the first year and once in the life of the asset. In the first year and once in the life of the asset. So, you can't expect me to compute initial allowance for an asset that has been existing for 4 years. That's not its first year. So, take note. Whether we are going to do that here, we will know. But by the time we go through the question again. Annual allowance. Every year the asset is put to use. Every year, every blessed year, that asset is entitled to annual allowance. Investment allowance is for a particular set of assets. Are we there? Particular set of assets. And which asset is that? It is for plant and machinery. P&M. Is that okay? So, let's go from there. I have this asset, motor vehicle, 12 million. Plant and machinery, or plant here, 6,500,000. He prepares his books to an accounting year end December 31st. You are required to compute the capital allowance and tax written down value. Capital allowance and tax written down value for 2007 to 9. Capital allowance, I've explained. What is tax written down value? The tax written down value of an asset, TWDV, tax written down value. Okay, TWDV of an asset is equals to cost minus initial allowance IA, are you there, minus annual allowance AA. That is the tax written down value of any asset. So this is what they want us to do. So let's go. Let's go. So what's the name of the business? Mr. Kayode. So we'll go off and say Mr. Kayode. Mr. Kayode. Okay. Computation. Okay. Of capital allowances. Okay. For 2007 to 2009. Your TWDV will follow suit. From the capital allowance, you will get the TWDV. Is that okay? So we'll move from here. Now, let's go back to the question and see 1 or 2 things again. Now, these assets were acquired in which year? Which asset were acquired in which year? We are told that in the year 2007, here, in the year 2007, these assets were acquired. This one, 2007. So, they will start enjoying capital allowance from 2007. So, my first year will be 2007. So, I'll come here and say, okay, as usual, for any capital allowance question, they must be shown in columnar form. You prepare the capital allowance in columnar form as long as the asset is more than 1. In this case, 2. Okay, so put them in columns. Column 1, column 2, and there must always be an additional column to house total. Are we there? So the first asset here is motor vehicle. So you do this motor vehicle. The second asset is plant. Are we together there? The next thing you will do is to bring in the IA and AA rates. I told you the lecture note that all the assets, all the QCE, they have initial allowance rate and annual allowance rate that will be given to you in the exam. Okay? So it is that rate you use in computing the capital allowances. And your capital allowance is made up of what? Initial allowance, annual allowance, investment allowance, and they all have rates. And note, I did not bring investment allowance here. I will tell you why. So, close it up. Because I have done this over many years, I know the rates offhand without thinking, okay? But for you, you'll be given in the exam. The last page of your question paper has all the rates. So don't bother. But for now, let's go with this. 50-25 means 50%, 25%. That's how it's written. 50%, 25%. 50-25. All right? Of course, no rate on that total. Now, the next thing you do is the first year. You bring down the first year. From this question, the first year is 2007. Abi? 2007, isn't it? Now, you start. Step 1. Go this way. You are seeing initial allowance there. Okay? IA, this is it. 50%. 50%. Okay? You now do, you have that in mind. Then the next thing you do is to bring down the cost. Bring down the, how much were these assets acquired? For how much were they acquired? Go back to the question. Let's go. For motor vehicle, it was acquired for 12 million. Abi? It was acquired for 12 million. Let's see that. This is it, 12 million. And then plant and machinery, 6.5 million. So that's the figures you take here. Motor vehicle cost 12 million. 12 million. Plant and machinery, 6.5 million. Okay. Now we go. Initial allowance. What is the rate up there? 50%. So you do 50% of 12 million. That is 6 million. Okay. 6 million. And it must be in jacket. Why must it be in jacket? Because if you go back to your FA, a little bit of FA, when you are depreciating an asset, you are reducing the life of the asset. Depreciation means estimated portion of the life of an asset that is written off every year. So this is the point here. Initial allowance and annual allowance that we refer to as capital allowance here is equivalent to depreciation in FA. So it will go off so that I can have a TWDV. In FA, we call it net book value at the end of the day. So that's why it must be in jacket. Plant, 50% of 6.5 million. That should give me 3,250,000. 3,250,000. Also in jacket. Okay. And we extend that to the total column. Because it is at the total column that at a glance, I can see the capital allowance. So a total of 6 million plus 3,250,000 should give me 9,250,000. This time around, not in jacket, because that is the final result. Next, you say AA, annual allowance. Annual allowance. What's the annual allowance? What is annual allowance? The allowance that is granted every year. And how do you compute the annual allowance? Refer to the formula I gave you. But here, it is cost minus IA. Cost minus IA. The balance is divided by N. Remember what N is. N is the expected life of the asset. And how do you get expected life of the asset? 100, that is a standard. 100 over AA rate. In this case, my AA rate is how much? What's the percentage of my AA here? 25%. So what is the expected life of this asset? The expected life of this asset is 100 divided by 25, which gives me 4. This time you say 4 years. Okay, 4 years. So if I want to get my AA, the balance I am getting from cost minus IA will be divided by 4 years. Okay, that will be divided by 4 years. So if I take away 6 million from 12 million, I will be left with 6 million, isn't it? If I take 6 million and divide by 4 years, I will be left with 1.5 million. I will have 1.5 million. So 1.5 million is my AA. Are you getting that? As straightforward as that. For plant and machinery, 6.5 million, take away 3,250,000, I'm left with 3,250,000. That will be divided by 4 again. Why? Because my AA rate here, just like I did with motor vehicle, is 25%. That will give me 4 years. So 3,250,000 divided by 4 gives me 3,250,000 divided by 4 is giving me 812,500. So 812,500. Okay, again, I will have a total under the total column that is 1.5 million, okay, plus 812,500. That's giving me 2,312,500. Again, not in jacket, remember. At this point, your investment allowance comes in. Remember investment allowance? It is granted only on plant and equipment. So, whether plant is standing alone, or it is called equipment alone, or it is called plant and equipment, or plant and machinery. Take note. Plant alone is entitled to investment allowance. Plant and equipment, as long as the word plant is there, is entitled to investment allowance. Even machinery is assumed to be plant and machinery. All right, is entitled to investment allowance. And take note, categorization of the assets. Categorization of the asset. What do I mean by categorization of the asset? You get to the exam hall, you are seeing something like somebody running a business center and has a photocopier. In the capital allowance rate, there's nothing like photocopier on the list of QCE. The onus is now left to you. It's on you to classify photocopier correctly. And the best classification is plant and equipment. Of course, you cannot classify photocopier under motor vehicle. You cannot classify photocopier under furniture and fitting. Okay? Because photocopier is a machine used to generate the income. Are we there? So take note. Now, investment allowance. Investment allowance. Investment allowance is granted on plant and equipment. And the note, very important note. One of the characteristics of investment allowance is that it is not taken into consideration in arriving at the TWDV. What that means is, I will not write it here like I've written all the other one, because if I do, it will affect the TWDV. Okay? So what do? You put it under here. And what is the rate? It is 10%. 10% on the cost. Our plant here is 6.5 million. 10% of that should give me 650,000. 650,000. So that sits down there. It sits there, but not here. At this point, I can now have my TWDV. Okay, so the TWDV will be, what is TWDV? I gave you the formula, how to get TWDV, the cost. For example, let's look at a motor vehicle, 12 million, okay, minus 6 million, okay, minus 1.5 million. So the TWDV for 2008, that's balance brought forward, is 4.5, yeah? 4.5 million. And let's look at plant. Plant will be 6.5 million minus 3,250,000. Okay. Minus 812,500. What do we have? I'm having 2,437,500. Okay, so we're not putting anything here because this is a total. This is a total. This is a total. So if at a glance, what's the total capital allowance for this Mr. Kayode in 2007? I'll just add these three up. I can do that there and say 9,250 plus 2,312,500. Okay, plus 650. I have a figure of 12,215,500. So let me put that here. Okay, 12 million capital allowance, 12,212,500. I hope we are right there. Let's take a small test. 6 million plus 3 million give me 9 million. Okay. 1.5 plus this give me 2.5. 9. Okay, that should be okay. All right. So let's move on. So it now means this is my TWDV. Then in 2008, YOA, I will not compute initial allowance again. Why? Because these assets are not new again, except there's a new asset for that year. But from the question, no new asset. So what will I compute? AA. Are we there? AA. And if your AA in the first year is correct, I'll take that again. If your AA in the first year is correct, where there is no proration, apportionment, the AA for subsequent year will also be correct. So you just copy and paste. Take note to 1. On what condition will you copy and paste? First year was in normal business, not on commencement. There was no commencement rule applied. You can copy. But if there was commencement rule applied, you will have apportioned the AA here, and it will not work again subsequently for you to copy and paste. So take note. So here, it was not on commencement, so I can copy and paste. Or shortcut. Another way of getting this figure is this. Take the TWDV, like in this case, 4.5 million, okay? Divide by the unexpired life. What is unexpired life? The life of this asset was supposed to be 4 years, isn't it? From what we calculated. 1 year is gone. So how many years remaining? 3 years. So if you divide 4.5 by 3, if you divide 4.5 by 3, you are going to get 1.5. Is it not the same 1.5 here? That's what I was saying. So 1.5 here. So that's just to confirm that you are right. Whether you pick outrightly or you divide by the balance of the unexpired life. Let's do this too. Let's do this to see if it will give us 812,500. 2,437,500 divided by how many years? 3, because it was also 4. I'm getting the same 812,500. Are you getting this? Okay. So you add up to go to the total column. 1,500,000 plus 812,500. That gives me 2,312,500. So that is it. That is the capital allowance for 2008. That is the capital allowance for 2007. You can go ahead and maybe still want to show the TWDV for 2009. For 2009. That is, you do this. You say TWDV, and that's where I'm going to stop because I was asked to. I'll go on. 2009. From 4.5, take away 1.5. I should be left with 3. Okay. 3 million. From 2,247,500, take away 812,500. I should be left with 1,625,000. Okay, you don't add if you don't add this because they're not on the same year. These are different years. You can't add this column together. You are not asked to compute capital allowance for all the years. you show the capital allowance for different years. Okay, so 2009 YOA, where I will stop. 2009 YOA, where I will stop. AA again, no IA, because the assets are not new. So having tested in 2008, all we need to do is copy and paste here. Copy and paste, and copy and paste. Okay, and definitely this total will also be 2312500. So that's that. That is that, and then we can also show the TWDV, but we won't go further because we are asked to stop in 2009. You can just bring it down. TWDV. Okay, TWDV. 1.5. This should be 1.5. Okay, this should be 812,500. That is it. So this is the simplest of capital allowance. With this, we will progress into other tougher one and more technical one. You see the variant, but how to compute initial and annual allowance is what I have shown you from the very beginning. All right, so on this note, say remain blessed and thank you.